So good afternoon. The topic for today's video would be your enhancing qualitative characteristics. We've discussed before your fundamental qualitative characteristics, and they are your relevance and faithful representation. Now, as I've mentioned before, for you to easily remember your enhancing qualitative characteristics, just remember our mnemonic VCAT, and VCAT stands for verifiability, comparability, understandability, and timeliness. So as a reminder, as I have mentioned before, even though we have these enhancing qualitative characteristics, we must not forget that no amount of enhancing qualitative characteristic can elevate the value of the information as being useful if it does not possess relevance and faithful representation. Again, our VCAT, our verifiability, comparability, understandability, and timeliness is only there to enhance information that is already useful. Now, before proceeding to the individual enhancing qualitative characteristics, I'd like to give you an idea on how these may be asked in the exams. A very common easy question is to ask the students whether they know the four enhancing qualitative characteristics. So the question would be like this: which of the following is not an enhancing qualitative characteristic? So you can expect that 3 out of the 4 enhancing qualitative characteristics will be there, and one other adjective will just be added in the choices. Once the students know of the VCAT mnemonic, it would be very easy for them to find the wrong answer, because they would just have to make sure that verifiability, comparability, understandability, and timeliness are present. So to counter my students' reliance on the mnemonic of VCAT, the question would still be the same. I would still ask which of the following is not an enhancing qualitative characteristic, but I will not give 3 out of the 4 enhancing qualitative characteristics. I will include in the choices a word that also starts with letter C, because throughout chapter 2 of the framework, there are a lot of words that are being discussed that starts with letter C. For example, aside from comparability, we also have consistency and completeness. We have discussed completeness earlier in your faithful representation, while consistency will be discussed later together with comparability. So I can still give verifiability and timeliness or understanding in the choices, but I'll make sure that there are other choices that starts with letter C aside from comparability. So it's possible that I will give either consistency, completeness, or even conservatism. Conservatism is also related to prudence. But at present, you don't have to remember conservatism, because even though it is supposed to be discussed together with prudence, conservatism is no longer tackled in the framework. So again, I always ask the students, remember VCAT. You do not forget that the C in VCAT stands for comparability. So to continue, when the enhancing qualitative characteristics are asked in the exams, the easy type of questions would simply give you again their definition, and all that is asked from you would be to identify the word that is being described in the question. In case verifiability is the one that is being asked, it would be very easy for you, because it would be very easy for you to determine that the word being described in the question is actually verifiability. The reason being, the definition provided in the framework conforms to the common usage of the word verifiable. As provided in the framework, verifiability means that different knowledgeable and independent observers could reach consensus, although not necessarily complete agreement, that a particular depiction is a faithful representation. Simply stated, we consider an information to be verifiable if multiple users can arrive at the same conclusion when given the same set of data or information. And that is exactly how a layman understands verifiability. So verifiability helps or enhances your faithful representation, because if an information is verifiable, one can be confident that the information being presented in the financial statements faithfully represent the transaction or economic phenomenon that is supposed to be reported. The framework mentions of 2 types of verification. We have direct verification and indirect verification. Direct verification means verifying an amount or other representation through direct observation. The best example for this one would be by counting your cash. You can verify the amount of cash that is to be reported by actually conducting a cash count. On the other hand, indirect verification means checking the inputs to a model, formula, or other technique and recalculating the outputs using the same methodology. A good example for this one would be for verifying the inventory cost estimation of a company. You verify the amount of inventory reported by the entity not by making an inventory count, but by reviewing and verifying the process used by the entity as well as the inputs that were used. The framework also raises an important point that quantified information need not be a single point estimate for it to be considered as a verifiable. Even a range of possible outcomes and the related probabilities can be verified. However, a big challenge for an information to be verifiable is when it involves forward-looking financial information. A simple example for this one would perhaps be the use of salvage value or residual value. As you may have discussed in your accounting in senior high school, depreciation is computed by taking into account estimated residual or salvage value. Your residual value or your salvage value is a forward-looking financial information. Since the information is forward-looking, then it can only be verified in a future period. So to help users whether they should use such forward-looking information, it would be necessary for the entity to disclose the underlying assumptions used to arrive at the information. Or in our example, the underlying assumptions used in determining the amount that we will use as our residual or salvage value. Our second enhancing qualitative characteristic is our comparability. Actually, in the framework, comparability was discussed first, and out of the four enhancing qualitative characteristics, comparability has the longest discussion in the framework. But as far as exams are concerned, if the question will just give you the definition of comparability, it would still be very easy for you to determine that the question is looking for comparability. The framework defines comparability as the qualitative characteristic that enables users to identify and understand similarities in and differences among items. So basically, comparability has the same context as the common usage of the term as it has in the framework. Now, two important concepts are closely related to comparability. We have your consistency and your uniformity. While consistency may be related to comparability, they are not the same. Consistency refers to the use of the same methods, procedures, and other policies throughout multiple periods or throughout entities in the same industry. So comparability can be viewed as the goal, while consistency is the means towards achieving comparability. If entities use the same procedure, method, and policies, then it would be very easy for financial statement users to compare such entities. If an entity uses the same policies, methods, and procedures year in and year out, it would also be equally easier for our financial statement users to compare information for the current year from the previous periods. So if you'll recall the objective of general purpose financial reporting, it is to provide our financial statement users with information so that they can make informed economic decisions. If you'll recall the decision needs of our financial statement users, it is primarily to help them decide whether they should make an investment, whether they should sell their investment, or whether they should continue to hold on to their investment. And comparability helps greatly the financial statement users to make such decision. For example, an entity may be choosing to invest in two companies. So the best thing for the financial statement user to do is to compare the financial performance and financial position of these entities. And making such comparison will only be possible if the financial information provided in their individual reports are comparable. So the goal of the accounting standards is to help making financial information more comparable so that it can easily be used by our financial statement users. So I don't think there's a need for more explanation why comparability is valuable to our financial statement users. It really helps them arrive at their decisions. If I'm choosing between investing in company A and company B, I will compare the financial reports of company A and company B. If I want to decide whether to continue my investment in this company or not, then I will just compare the financial information provided in the present and the past financial reports of the entity. However, even though the trait of comparability is desirable, We do not sacrifice the value of the information for the sake of comparability. Definitely, if an entity uses uniform policies, methods, and procedures year in and year out, it would be very easy to compare the financial reports of such entity. However, if there are new ways in presenting financial information that would make it more useful, that will make it more relevant, that would help the reporting entity faithfully represent the transaction or economic phenomenon, then definitely we allow entities to use the new policy, method, or procedure. Again, we do not sacrifice the quality of information for the sake of comparability. Another point that the framework mentions about comparability is that as long as information possesses both relevance and faithful representation, there is a high chance that such information possesses already comparability. However, the degree of comparability in our financial information is significantly diminished if the reporting entity is presented with alternatives. So for example, a standard allows entities to choose between two alternatives. So even if all entities are compliant with the standard, but since they may not choose the same alternative given in the standard, then that will diminish the comparability of the information. It is up to the board to make sure that the alternatives they provide result in useful financial information enough to compensate the diminished degree of comparability. Comparability is not the same as uniformity. So while there may be times that uniformity will help achieve comparability, but again, we limit the demand for uniformity only for those items or entities that should actually be uniform. We do not force different transactions or different reporting entities to be uniform just to make all reporting entities and all transactions comparable. So our third enhancing qualitative characteristic is our understandability. Understandability is achieved by classifying, characterizing, and presenting information clearly and concisely. It's important that the financial information that will be presented in our financial reports are going to be understandable by our financial statement users. But the framework warns us, especially for complex transactions, that we do not sacrifice the completeness of the financial information, we do not sacrifice the value of faithful representation for the sake of making the information understandable. Very important concept here, class, is that financial statement users are expected and required to possess a reasonable knowledge of business and economic activities. It is not required that financial reports are to be understood by everyone. A person who wishes to make use of our financial reports should make it his obligation to equip himself with sufficient knowledge for him to make use of such information in making his decision. We do not make the financial reports for it to be understood by clueless individuals. While it is our goal for our financial reports to be understandable so that it can be considered as useful by our primary users also have the obligation to make themselves competent in order for them to be able to use the financial reports. If we are to sacrifice the completeness of our financial reports for the sake of understandability, then definitely our financial reports would become misleading. And the moment that financial reports become misleading, it loses its value and usefulness to our financial statement users. So on the part of our financial statement users, it would be possible that they would have to consult or seek an advice from a person that has greater ability to understand the reported complex transactions. The goal here again is not to make it understandable for everyone. Our goal is to at least make it understandable to persons equipped with sufficient knowledge in business and economic activities. The final enhancing qualitative characteristic mentioned in the framework is your timeliness. Again, if asked as a question, it would be very easy for you to identify that the term being described in the question is timeliness, because the definition provided by the framework for timeliness conforms to the common usage of the word. The framework defines timeliness as having information available to decision makers in time to be capable of influencing their decisions. Generally, the older the information, the less useful it will be. So our goal is to provide the information before it completely loses its value or use. However, there may be instances in which old information may still be considered as timely, just like when we use old information to help financial statement users identify and assess trends. So, as far as the IASB is concerned, their goal is to come up with accounting standards that would maximize the enhancing qualitative characteristic. If you'll recall, we have discussed before that there is a process or a step in applying the fundamental qualitative characteristics. It is important to note that no such process is to be undertaken for our enhancing qualitative characteristics. It is even possible that our accounting standards would diminish one enhancing qualitative characteristic for the sake of another enhancing qualitative characteristic. So as I've mentioned before, it's possible for accounting standards to require an entirely new or different requirement if it helps improve the relevance and the faithful representation in our reports, notwithstanding that it will diminish the comparability. So that would be our enhancing qualitative characteristics, our verifiability, comparability, understandability, and timeliness.